I'm proud to call Larry Kotlikoff, your moderator, my colleague at Boston University. He was instrumental in creating the Center for Finance, Law, and Policy that I have the honor of directing. And he's a renowned economist in his own right, prolific author, and he contributed actually to the debate about which he's going to now moderate by publishing a book called Jimmy Stewart is Dead, if I recall the title. So what I'm going to be listening for is the panel before seemed to have a consensus that banks still are special. Then if that is the case, where do we draw the line? What is the difference between banking activities and non-banking activities? And Jerry pointed out the shadow banking system is a two-way street, and Ray indicated that you shouldn't regulate anything that's in the shadow banking system just because it's there. So there are a lot of nuances and there are a lot of questions that need to be answered when we talk about the separation of banking and other things. That's the thrust of this panel, but I'm sure they're going to get into other issues as well. So, Larry, have at it.
Thanks, Con. It's a great pleasure to be here, an honor. I want to congratulate Con and Tom and others who set up this terrific conference, and obviously happy birthday to the OCC. I haven't written anything in my book that said it should be abolished, just to be clear. And we have two Jimmy Stewarts right here with us. There are a few left, they're not all dead. These are people that are extremely distinguished. They really need no introduction, but just for those, a few of you may be on the younger side and not know that John Reed was chairman of Citicorp for I guess 16 years, from 1984 through 2000, and that he transformed Citigroup into a global consumer bank, and he then rescued the New York Stock Exchange for many years, and today he's chairman of the board of MIT, or the corporation of MIT. In other words, John is running MIT now as well, to its great benefit. Eugene Ludwig's an old friend of mine, and he was a distinguished and transformational controller of the currency between 1993 and 1998. Then and during that period, he put special emphasis on making sure that low and moderate income households would be able to get loans from the banking industry and vigorously enforce the Community Investment Act. He also then turned to working with Bankers Trust as vice chairman, and subsequently he founded and is now CEO of the Promontory Financial Group. So these are two fantastic folks to talk to us about their views of the financial crisis, the reforms that have been implemented so far, and where we need to go. The title of this talk is Protecting the Bank. I think we really want to change that to Protecting the Financial System, because it's not just the banks that need to be protected, it's the entire financial system. And it's not just the United States financial system, it's the global financial system, of which the American financial industry is so much a part of. Let me just say, just for maybe three minutes here, and I do want to leave us a fair amount of time at the end for Q&A for everybody to participate, just a few words about the economist's perspective on this, or at least one economist's perspective. So I'm a professor of economics, and the way I look at what we have here in the financial system is that we have two public goods at stake. One is the financial highway system. Think about your physical highway system. That's a public good. A lot of people can use it at the same time. It doesn't interfere with other people unless there's congestion. And you want to keep that open and free and working. You wouldn't want the gas stations who are kind of helping manage the system to gamble with their businesses and lead it to potentially break down which would completely cut off traditional commerce, shipping of goods and services. So the financial system is very much a public good. It's a financial highway system. The banks and other shadow banks are running that system. And what they're doing is gambling with it. That's what they're doing. They're gambling with a public good. There's a second public good that is the level of confidence in the economy. When Lehman Brothers failed in 2008, its building did not collapse. None of the people working there died. There was nothing physical that happened to the economy. But the failure of Lehman scared the hell out of everybody, and we had collective panic. So people who are employers, small, big employers, started seeing all this panic, all the discussion of the next Great Depression. The Google searches for that spiked sky high in September after Lehman went under. So the press had a field day. It was something they could write about. The politicians had a field day. Everybody got nervous, and the employers decided, let's fire people, let's fire my employees before my customers stop showing up. And over the next 19 months, 8.5 million Americans were kicked out onto the street from their jobs. That was a tragedy, and it was, and each employer was firing somebody else's customer. And so we had a coordinated panic. And that's the other public good. The state of confidence is a public good. And when the banking system fails, and it could be an insurance company, it could be LTCM, it could be a small thing that flips that degree of confidence, then we can have a massive economic fallout. So we need to make the system, we need to protect these public goods, and that's really the discussion we're going to be having today. I'm going to ask Eugene to start us off with some comments about how he views protecting the financial system, and then John will follow, and then we're going to have some pointed questions, specific questions, and then we're going to try and leave about 20 minutes at the end for all you folks to interact. Okay, thanks.
Thanks, Larry. Let me just grab the text here. Oh, my. Okay. First, Larry, it's an honor to be here, and I particularly wanted to single out Con Hurley and Boston University for putting this together. Con and the university have done a great job in focusing in a serious way on the academic issues that surround our industry, and congratulations to them to putting this together. Along with, I might say, Jesse Stiller of the OCC. In this regard, of course, this is a particularly big event because it's the 150th anniversary of the OCC. I myself aspire to 150 personally, but at least the organization made it that far. We're also lucky as an organization not only to have an organization filled with extraordinary men and women, if I may say having once been a part of the OCC, I take tremendous pride in the organization, but also having an enormously capable and highly intellectually strong controller of the currency, Tom Curry, and importantly, like the men and women of the OCC, somebody who's been dedicated to public service and the well-being of the financial system. It's also an honor, I might say, standing in for my good friend Paul Volcker, who I'm happy to say I think has a very bad cold, but nothing worse. He's a person of exceptional character, intellect, and integrity, as everybody knows, and I'm proud to call him a friend. And of course, I'm honored to be on the platform with John Reed, who I have a great deal of respect for, and once supervised his institution, spent some time with John, and realized his capability is extraordinary. Now, the issue before us that is the topic of this panel specifically is sealing off the bank, as I remember. And so to what degree can we or should we wall off, ring fence, if you will, banks? And there, I think, an important premise for this is when the OCC was founded 150 years ago by just the brilliant ability and intellect of Abraham Lincoln. He actually personally sent his secretary to lobby the Congress to get the National Currency Act, National Banking Act through. And I'm sure it's true for Tom, it was true for me. Right over my shoulder was the National Banking Act and the National Currency Act, interlineated by Abraham Lincoln. He actually spent the time to work on the act himself. It was a brilliant stroke. But at that time, the banking system was the financial system in essence. And in 150 years, the banking system is still enormously important, but a lot has changed. And it is not the whole financial system, and that to some degree is the heart of my remarks about sealing it off. Because the question, I think, is will walling them off make them safer and or the financial system safer? And behind this, it seems to me, is a broader question. What is the right relationship between formal chartered banks and the rest of the financial system? And I think the answer is, as it is for much of finance, it's a matter of proportion, judgment, and balance. Right now, we're at an important inflection point, it seems to me. Many steps have been taken to strengthen banks and banking, good steps. Additional capital and liquidity have made the system safer. We can take pride, I think, as a nation for having confronted new financial realities, learned from the past, and made changes. I mean, the wonderful thing about America, you can, God knows, see it in these wonderful regulatory institutions and in the Congress. We confront our problems, we deal with them, we make changes, and we move on. But as we implement the new rules, Dodd-Frank, Basel III, and its progeny, we're in danger, I think, of letting the pendulum swing to excess, of losing balance to the detriment of the financial system and the broader economy. In some ways, this is the hardest period. So we've made the changes. Implementation is always less fun and less topical and less newsworthy. But for those of us who have toiled or toil in this sort of intricacies of this, it seems to me that's the most important part, or a very important part. Now, a great part of the risk lies in the shadow banking system, it seems to me, a $9.2 trillion sector that grows every day. The shadow banking system doesn't, in a sense you say it doesn't seem like a big thing. You read about the banks on the front page of these papers. You typically and often don't read about the pieces of the shadow banking system, but it's enormous, and it's growing every day. That is, the more we lock banks off from the real financial economy, the more financial activity is moving to the unregulated financial players. We can see it almost every day in the newspapers as talent is draining away from the banking system and moving to the unregulated sector. I mean, any of us who read the American Banker or any of the financial press can see it almost daily, this transformation that's going on. And in our highly dynamic, high-tech age, this swing of the pendulum can happen rather quickly. Internet peer-to-peer lending, hedge funds, and other funds, that's only the tip of a very big iceberg that's getting bigger. Now, as someone who believes in regulation and supervision, me, I myself am uncomfortable with the notion that regulating by chartered type as distinct from activity makes sense. Isn't the right answer like activity, like size of entity, like regulation? If an activity is risky, it's not made less risky by putting it into an entity that has a different charter, a different name on the door, if you will, and much less regulation and supervision. And goodness knows, I think you can say that for consumers importantly, that a consumer who doesn't even know the name of the door, going into an unregulated institution and getting abused, it seems to me, is something we all ought to worry about. Banks are different to a degree. Deposit insurance confers benefits, and taking deposits, insured or not, and making loans along with maturity transformation is a tough business requiring an enormous amount of skill. And yes, we found after 150 years of regulation and supervision that there is a great deal of value that comes with men and women, such as those at the OCC, with the experience and responsibility to help ensure honest dealing and avoidance of excess. I think one can't overstate, in my view, the importance to the well-being of the financial system of the supervisory excellence that you see at the OCC and other financial regulatory agencies. Everything cannot be done by rule. A lot of what really makes a difference in the safety of the system has to be done by feel and touch. And that supervisory experience that has developed, and it takes generations to develop, at an organization like the OCC makes a profound difference, in my view, in the safety of the system. But banks are not, in essence, the entire financial system, as I mentioned earlier. It's not the way it was in 1863 when the OCC was founded. They are inextricably intertwined with an ever more dynamic financial system. And history has taught us that they cannot be walled off, nor have they been the flashpoint, the actual causes of our greatest financial calamities. And I must say that this is my own biggest bugbear. The Great Depression, as scholars today understand, was caused by restrictive monetary and trade policies. Bank failures did not cause the Great Depression. They were, in many ways, caused by the Great Depression. I mean, every time there's a financial crisis in the United States because of our history in banking, we call it a banking crisis. So the Great Depression, people view it very much as a banking crisis. But if you actually look historically, now that academics like Larry, one of my most talented academic friends in this area, look at these, they find that really the Great Depression is a cause of, caused by governmental policies. Now, it's also instructive to note that in what is now called the Great Recession, or the financial crisis of 2008, I know Great Recession is kind of a nice euphemism, I think, the failures that brought the country to the brink of disaster were not bank failures. Just think of it. Bear Stearns, Lehman Brothers, AIG, Fannie Mae, and Freddie Mac. The triggers for the crisis, they're not banks. And when these non-banks, less regulated financial players got sick, so did the banking system. In that sense, there's parallel to the 1930s. Banks are a part of the transmission process, but in both cases, we're not, in my view, the cause. Now, in part, this is an issue of competitive dynamics. In other words, sort of why do banks get caught up in this? Part of, I think, the dangers of the shadow system is competitive dynamics. If you're going to stay in business and you have this enormous shadow system that can do anything it wants and is unregulated, the pressures move you in that direction. And in addition, of course, it's an issue of connectivity, natural connectivity of the financial sector. Now, this is not to say that banks are not important players in the economy, and they are indeed transmission belts for financial, as I just mentioned. They should be regulated and supervised by experts such as those at the OCC and other bank regulators. But to think that we can solve serious financial and systemic problems by walling banks off is, I believe, a big mistake. The financial crisis of 2000 itself teaches us that walling banks off within bank holding companies is not the answer. That was viewed as one solution of the problem, but it's not. Where bank holding company affiliates got into trouble, the entire banking organization gets into trouble, including the bank. And as I mentioned, walling them off from other financial players doesn't work either. So where does this leave us? To my mind, it suggests the following rules. 1, banks ought to be regulated and supervised by knowledgeable specialists, which we're blessed to have at organizations like the OCC, and importantly, the OCC. 2, it suggests that we should not rely upon artificial walls between banking and non-banking. We'll not solve our financial problems by over-regulating banks and squeezing activities out to the unregulated sector. In my view, quite the contrary. And 3, to the extent an activity is risky, it should be regulated throughout the financial system in an even-handed way. Again, I come back to what I think is the right rule. Like activity, like size of activity and entity, like regulation. Of course, this takes some doing, but anyway, those are my thoughts, and thank you very much for listening.
I hesitate to get up because I met with Larry for lunch a couple weeks ago and we agreed we would have no starting comments. And since I thought I was going to be talking with Paul Volcker, and he and I have often spoken about the Volcker rule and so forth, so I'm sitting here sort of reacting real time. But let me say a few things. First of all, I agree very much with Jerry Corrigan, banks are special. I do think that you have to look at function, you have to look at size. I hadn't intended to talk very much about regulation. I've experienced it, and I must say it's a very important component of the industry. When I got in trouble in the 90s, had we not had the interaction with the regulators that we did, I doubt seriously that we would have gotten out as well as we had. In other words, it really did help in the dealing with the problems we were dealing with. The thing I would say is this, and I'm going to introduce a couple new ideas here. One is, when you think about banks, I think you have to understand something about bank customers. There's a small but very large and very important set of customers who enjoy access to the capital markets. They've been rated, they have access to the capital markets, they become customers of banks, they also become customers of institutions who specialize in intermediating the capital markets. That is what we were dealing with when we dealt with our most recent crisis. The great majority of customers for the banking industry do not have access to the capital markets. They are not part of the problems that we had here in 2008. They get impacted by it. But remember, for the great majority of bank customers, they're looking for banks to finance them in their activities. They don't have the luxury of issuing debt or other instruments that can be sold in the capital markets. Often they don't have much of an equity base, and certainly it's not one that is traded. That industry, which has gone through its troubles, I like Jerry's comments about going back to the 80s. That industry, when they got into trouble, did not constitute a systemic risk to the economy. It could be very devastating to a local economy. I could remember when the Texas banks got in trouble, and it was disastrous for the banks themselves. It certainly did not help the local economy, but they did not imply the systemic risk that exists with the larger institutions that are dealing with these larger enterprises that do in fact have access to the capital markets. So when we talk about the industry, you should talk about an industry that serves people who have access to capital markets and differentiate it from those who do not. And then when you look at the industry, particularly the portion of it that deals with entities that have access to the capital markets, there's been an immense transformation that I did not have to live with totally during my career. I just saw the beginning of it. Banks traditionally had provided credit to their customers. Often, 7-8-year loans were long-term finance. If you wanted anything beyond that, you went in the days of Glass-Steagall to somebody who dealt with the capital markets, who could issue bonds or equity on your behalf, what I call capital, as opposed to working capital. The big transformation that took place in the industry was when securitization came along. All of a sudden, the industry shifted its focus, and many of the customers were not the people who originated credits, but they were customers who wanted to buy an investment product. People who manage money, and managing money in the United States and in the developed part of the world is a very large business, because we have large pools of capital that need to be professionally managed, and these pools of capital tend to demand performance. And it's a very competitive arena. And if you remember during the 60s and 70s, when the markets didn't really do all that well, there was a tremendous amount of pressure put on investment managers who were managing pension funds and college endowments and things of this sort to get performance, because the institutions they were dealing with required that performance for their own economic well-being. The industry responded by becoming very aggressive. The idea of shareholder value is something that emerged from that, and it had a profound impact on the structure of the financial sector, because all of a sudden, people who used to simply provide credit and allocate capital, as economists would describe it, started looking at how they could create products that could be packaged and sold to an investment industry that was looking for higher yielding products than those which were traditionally available to them. So the industry shifted very, very importantly, to creating products for investors. And that's where the idea of packaging mortgages came from, and that, of course, has been sliced and diced and made very sophisticated so that you can now create products that don't really exist. They're sort of synthetic products that you create and sell to would-be investors. As this transformation has taken place, it changed the structure of the industry that traditionally deals with customers who have access to markets. And it allowed the industry to take products that normally would sit on the balance sheet of banks that didn't deal with customers that had access to markets. You could buy those assets, package them, sell them off to customers, and the industry has changed. And with that change, the vulnerability of the system, the highway system, Larry, that you're talking about, became at risk because if a difficulty developed within one of these institutions, they were so interconnected and so tied to other institutions that the notion of systemic risk, a word that couldn't even have been pronounced when I first joined the banking business, this notion of systemic risk became a reality. So we're now dealing with the issue of how can we have a healthy banking system that provides the functions that the society needs, and Larry, I like your highway analogy, and yet live in a world where systemic risk doesn't take on this character that you also referred to, which is the fear factor that leads to an actual close down where you can't use the highway system that's been built because everybody's scared to get in their car and get on it. So that's what we're talking about now. The notion that banks are special is important because they do have a particular role to play because of their depository function and because of their function in the clearing and settlement mechanisms, most importantly for money transfer purposes, which are absolutely fundamental to the operation of this highway system. When Mr. Volcker came up with the notion, and I don't know to what extent, it's just become a label as opposed to an idea, the idea that things that are banks that enjoy the protection of depository insurance and access to the liquidity at the Fed, that they should not be using their institution for purposes of speculation with their own capital. They could work on behalf of their customers, but they should not be engaged in trading activities for their own account. I joined in supporting this argument and frankly in supporting a separation of those who engage primarily in capital markets from those who do not, and the word is primarily, because of managerial issues, and that is something that is not typically in the conversation, but the only skill that I bring to this discussion is the fact that for 30 years I in fact was a manager within a bank. I'm not a trained economist particularly. I've never been a regulator, although I've come to know regulators pretty well. My only contribution to the discussion is I have had the responsibility to in fact run a banking institution. I would tell you from a managerial point of view, the type of management, and again, I go back to one of Jerry's comments, which I think is extremely important, which has to do with culture, values, ethics, and so forth and so on, associated with the management of institutions. The culture and the management of an institution that is a traditional bank, as we imagine it in our minds, as opposed to an institution that deals primarily in the capital markets, or an institution that deals primarily in trying to create investment product. These require different managements, different cultures, and different skills. And I would argue for a separation based on managerial differences. I think it would be better for the structure of the industry and for the problems we're dealing with if you could get the managerial separation between these various things and take that into account. Because ultimately, when you deal with crises, the structure of the management and the capability of the management is extremely important. And I do think we would benefit if there was some compartmentalization based upon this managerial difference as well as the functional difference. So why don't I sit down and your questions will elaborate.
Great. Thank you, John. So let me ask a few quick questions to you, quick in the sense of maybe you could give us quick answers so we can get everybody a broader sense of your general views. And then we'll, again, in about 25 minutes, we'll move to some Q&A. So do you think the system is safer today than in 2007? Let me start with Eugene.
Absolutely. I think the changes of the last few years have been profound. You've got vastly increased capital standards, increased liquidity requirements, and a whole panoply of other requirements, and some new good offices like the Office of Financial Research at the Treasury is a big step forward in terms of looking at the system from a systemic perspective. Having said that, I think that the implementation of these rules as we go forward is profoundly important, because where the banking industry may be safer, the whole financial system may be weakened if what we have is a moving of activity into this shadow banking system without any regulation or capital standards or liquidity.
So do you think the overall financial system is safer, or are you kind of not so clear on that? Overall?
Overall, probably better, but the shift is dangerous, and it's something that has to be watched pretty closely.
Okay. John?
I don't think it's safer. No question the banking industry is better capitalized, and that presumably is going to continue. It's certainly alert. You know, people are not sleeping, and people are paying an awful lot of attention. On the other hand, the interconnectedness of the major financial institutions, those that are deemed to be systemically important, if anything, is greater. The institutions are greater. I doubt seriously. I think the fact that we have more capital and people are paying attention makes the likelihood of a problem smaller. But if a problem were to develop, I think they're so interconnected now that we'd be right back to where we were with bigger institutions, and it would take a hell of a lot of money. You know, so my sense, you know, if we were flying on an airplane and you wanted to say, is the risk of this plane crashing going up or going down? Probably the risk is going down, the probability of the crash. But I tell you, there are going to be a lot of dead people if the plane crashes.
It's a bigger airplane.
It's a bigger airplane.
I see. Do you guys think that the role of a financial system is to gamble with this public good, or just to intermediate between the households who want to save and lend money, and the households who want to borrow money, and also the households who want to invest money, and the firms, the non-financial firms who want to borrow and also sell securities? Why do we need the financial intermediaries to gamble with the financial highway at all? I've not figured that one out. Are they somehow adding some value? We wouldn't let gas stations systematically gamble with their businesses. They could gamble on their own, but we wouldn't let them sell securities. Like, for example, we wouldn't allow them to sell forward contracts on gasoline and all do the same, take the same position and all go broke at once and all leave their businesses with the keys in their hands to the pump. That would be ruled out immediately by Congress. But yet we're letting the financial system, broadly speaking, continue to gamble. You're telling us we got this big jet that could crash. Jerry was telling us earlier today that things almost went south big time in the early 80s. We just saw what happened globally in 2008. Isn't it time for the financial intermediaries to stop gambling entirely with the financial highway system?
Well, Larry, if you ask the question, am I in favor of gambling in the financial system? The answer is affirmatively no, no gambling. but the issue, I think, is a bit more complex, and I know you say that as a way to sort of elicit, interest here, provoke comment. Yeah. Is the nature of the transformation process is risk-taking. And in order to foment economic activity, whoever's lending money is taking risk. They're taking calculated risk. It's not surety. If you call that gambling, then the whole financial system has always gambled to a degree. It's the nature of the product. The question, I think, is to the extent that the risk-taking is as controlled, thoughtful, regulated, and supervised as it can be, consistent with the needs of the society. And there is that's where it gets complicated, and I will even say nerdy, because you have to make decisions how much risk you're willing to take, not whether or not you take any risk.
Scale makes a big difference. The fact of the matter is individual gas stations go broke, and the highway's fine. You may have to drive an extra 5 miles to get your gas. Individual banks, you must take risk. You use gambling, obviously a loaded term. You must take risk, but if they're individual size so that you're not threatening the entire highway, that, in fact, has worked out pretty well. There are societies that use their banks for economic purposes and basically cause them to, ignore risks and simply support certain industries and so forth and so on. If the government's willing to bail them out at the end of that, it works pretty well. The Korean banking system, which I know a little bit about, was used in that fashion, but when they got in trouble, the government was there, and so depositors were not at risk. That's not our style. What we're sort of saying is, look, we don't want all the gas stations taking the same risks, and we don't want them all owned by a single entity that is taking risks that might result in all the gas stations getting closed. So it's a question of scale. The reason we talk about systemic risk is we say there is a set of institutions whose scale is such that we worry about them because they would have second-order effects that we're not willing to live with. So it seems to me that it isn't the function. It isn't that, hey, a bank is doing something that we don't want them to do. Banks will take risk. Almost all of the bank failures are credit failures. Shipping, so forth and so on, you lend, goes bad, you have big problem. If the scale is distributed so that you're not closing the highways down, it's unfortunate, but it works. Your question is, hey, can we risk the highways? And the answer is no, we should not, and that's why we have this big discussion.
But Larry, and John, I would go a bit farther in this regard, that systemic risk, yes, can be caused by a panoply of large institutions, but the Great Depression was a systemic event, and we didn't have institutions of the scale we do today. It seems to me that we are always going to have, from time to time, challenging global events. It's the nature, I think, of finance and the pendulum swing. The reason institutions like the OCC make such a difference is because while regulations can do some things to lower the probability and perhaps the extent of systemic events, the on-the-ground, day-to-day activities dealing with entities that are flying in real time, to use your analogy, is enormously important.
So let me press you guys a little bit on this. You said it's kind of important for the financial intermediaries to take the risk. In 1795, Frederick the Great of Prussia, and he also owned Denmark at that point, he set up something called the covered bond system, which is basically, if you look at it, I think it's pretty much an equity-based mutual fund system. So here I am, I want to lend money to John so that he can buy a house. He's trying to sell me his mortgage. you're a mutual fund in between us. You sell shares to me and others who are willing to buy a pool of mortgages. It's be a closed-end mutual fund. It's a 100% equity financed example here. So now you're a financial institution that can never go broke. You're part of the financial highway that's now perfectly secure. And the covered bond system has worked really well in Europe for centuries now. Would you favor moving our mortgage system to a covered bond, 100% equity-based? They use the word bond, but it's really equity-based mutual fund system like they have in Europe and those parts of Europe where they have it, as a way of taking some of the risk out of the intermediaries. Yes, there is risk. There is my need to risk my money with John, but there's no need for you, Eugene, to risk your institution, your gas station.
Larry, I'm not sure whether if you had a one-to-one capital versus lending ratio, which is what that suggests, you would indeed eliminate systemic risk. I don't know whether that's the case, but I do know that what we have admitted in the financial system for several hundred years is to some degree a leverage model. In other words, banks, in fact, are levered. So is the rest of the financial system. That is, the capital base is not one-to-one with regard to the risks taken in lending. And we have believed, for a couple hundred years, I don't mean just the United States, I mean globally, that kind of leverage added value to growth and economic development. I think that is, you're at the heart of a very big issue. And it seems to me it does go to I hate to keep harking back in the shadow system, but one of the good things that's come out of increasing capital is the leverage in the banking system has come down. So you still have a leveraged system, but a leveraged system that is more contained. By the way, prior to the crisis, the banking system was much more levered than the non-leveraged system, even so. Today, however, you still have, while the banking system, say, is levered 10 to 1, 12 to 1, you have the shadow system levered 50 to 70 to 1, as in the old days in many of these funds. So you've got to decide what the balance is, and those are the kinds of difficult questions that I know you put your mind to, and that's why academic focus on these things is so important.
John, what do you think?
I think the question's been answered.
Okay. So, well, I mean, this thing has worked pretty well in Europe for a couple hundred years. I guess the question is whether we do have the option of switching to it. There have been members of Congress that have thought this, even Secretary Geithner thought that this was a way to move.
Europe has a banking system as well, and it's certainly as exposed and maybe in less good shape than ours.
Yeah.
So it isn't as if the society is operating in a different way.
So let me push you on the question of opacity. Sheila Bair was saying that our system's far too opaque. Would you agree with that? I mean, let me just give the story of the Tylenol scare back in 1982 that probably most of you will remember. There were 4 bottles of Tylenol that were sold in an undisclosed manner, in the sense that there was no safety seals back then. So somebody put in cyanide in these bottles, 4 bottles of Tylenol, and within a few days, 7 people died from eating this stuff. And around the world, there were 30 million bottles. So just 4 bottles of Tylenol that people knew were bad, were poisonous. 30, and there could have been others, but nobody knew for sure because there was no safety seals on the containers. Around the world, places like Thailand, everybody decided that stuff's too dangerous to buy. That market just dropped like crazy. There was a run on Tylenol, if you like. A $100 million market went to zero. Now, what did Johnson & Johnson do? They threw away all the old Tylenol, they recalled it, and they repackaged it with safety sealed containers. That's why we can't open anything these days. Now, that's an act of disclosure. We don't have much disclosure, as far as I can tell, as far as Sheila can tell, in the financial system. So we have kind of faith-based banking. People are investing money in these, I'm lending money to your bank, Gene, you're in the middle, and you're lending it to John, but you might be Angelo Mazzillo and be involved in no doc loans, and I won't know. And then I get a little bit of news that there might be some bad mortgages that you've made, and suddenly I panic, and I get scared and try to get my money out, and others do as well. And I'm not just scared about losing money, I'm scared about what other people are scared about. I'm scared about them running on you too. And then the whole thing collapses. Do we need more disclosure? Do we need vastly more disclosure? Do we need an FDA for the financial services sector so that we can see what's in those bottles?
Beyond being a great economist, you're an expert at provocative questions. I think this, unfortunately, the situation is more complicated in this regard. The one thing one wants to avoid is financial panics. And while I'm a huge fan of transparency, transparency has got to be clear, and it's very hard sometimes not to panic people with information that may be totally unclear to them. Sadly, financial literacy in this country, even among well-educated people, is remarkably low, actually. And that's a huge, I think, responsibility we all have to sort of get ourselves better educated and everyone else. But having said that, it is. And the question is what information one gives out and how one gives it out without causing a financial panic, a la Jimmy Stewart. So that's something that the bank regulatory agencies have poured over for generations. How much information to give out. If you gave every single piece of information out that you could possibly have, you could really have it misused and misinformation, and also a greater difficulty in disciplining the institutions. Interestingly enough, I mean, if you want to get philosophical, another area to study is that there are societies in the world, you think of China, you certainly think also to some degree Europe, where the transparency is less than in the United States. And you wonder whether or not with that lack of transparency, you actually are likely to have less panics and less run on institutions. Now, I'm not advocating for those systems by any means, but this question of transparency, how much you recognize, how much is mark to market is very difficult stuff and potentially highly volatile stuff.
John?
Yeah, I agree. I mean, you have to have some reliance on the institution just for a division of labor, if nothing else. If you trust the institution, they're making judgments about credit and risks that they're going to take. You have some track record. Yes, you need some degree of transparency. No one knows how much. I'll tell you, having run a bank where you have infinite transparency, in other words, the management of the bank could have as much information as they want about anything that is going on. Even there, you don't get rid of the risks just because you understand. You may get rid of concentrations of risk and things of this sort, but, and this is one of my objections to the risk-based capital formulation, I don't think we know what the risks are until after the fact. And therefore, I really am, sort of agnostic. I sort of say all assets are risky. We don't know how risky. And so you got to manage them as if there is a hidden risk. And it isn't a lack of transparency. It's a question of judgment. If the price of oil drops from $100 a barrel to $50 a barrel, I assure you there'll be risks in your portfolio that you didn't know were there, because there are a lot of people who are sustained at the price levels that existed at the time. Banking industries, by and large, can't take price adjustments. If you think a building's worth $100 million and then next week it's worth 70, you undoubtedly have a bad loan on your hands. And so it seems to me that transparency is important in order to gain credibility with your depositors and your investors. You want to tell them whatever they might need to make an informed judgment as to whether they want to deposit with you or not. And the reason the FDIC exists is they came in and provided an umbrella that got rid of that kind of judgment. Then you want, and by the way, one of the reasons that the Chinese and the European systems work is because the government has a history of protecting depositors, and people are willing to live with less transparency. When you get into a shadow banking situation where you have more sophisticated investors, they're going to demand the kind of information they want from the people who are managing their money, and they're going to insist upon it. So I think having transparency is important. I think it's vital, but ultimately transparency isn't going to get rid of the risks, because the people who have total transparency, which is the management, they make mistakes about risk.
Okay.
That's a really good point.
Well, let me push on the, Lehman Brothers kept all this information to itself, and a few days before it went under, I think on September 12th, it put out a report that said it had 11% capital, which is higher than I think most of the banks have in these stress tests. And the SEC must have approved this document because they'd been in the bank since bears had crashed. So because nobody could actually investigate the assets online, or the public didn't have the information, the hedge funds might have had some information, but nobody could really tell, so they all ran.
Can I say something about that?
Okay.
Look, I went through a crisis, Jerry knows it better than I, in the 90s where people were worried about Citi. I spent tons of time talking to the people who lend to us. I talked to the other banks who gave us lines of credits and so forth and so on. And the level of disclosure exceeded by far anything that was in the public domain. And they were very interested in just seeing me and getting a sense, hey, is Reed okay? Is Reed telling the truth? Is this guy capable or is he not capable? That level of disclosure undoubtedly existed with Lehman, and the funders must have reached the conclusion that Lehman wasn't going to make it. It had nothing to do with public disclosure. It had nothing to do with 11% capital requirements. You have counterparties who are funding you if you're in the security business, as they were. Almost all your funding is coming from counterparties. They are getting all of the disclosure they want. If a major counterparty calls and says, hey, I want to come over and I want to talk to you about what's going on, you meet with them, you talk to them, so forth and so on. What happened is, for good or for evil, the firm was unable to convince their lenders that they, in fact, were going to get out of this, and so they were unwilling to take the risks. But this occurs anytime a company is in difficulty. Suppliers, if you're a retail organization, you go out of business because your suppliers quit shipping. They won't ship to you. And it's all a question of judgments made by the counterparties, and it has very little to do with public disclosure. It's all the interaction that occurs between funders and the institution. Regulators play an important role in the banking industry there, because if the Bank of England says, not to worry, these guys are going to be okay, other lenders will place a certain amount of credibility on what the Bank of England says.
Well, I think what John said is profoundly important in terms of the way it really works. And the problem, if you mechanize everything in a mark-to-market environment, in a panic, everybody's dead. If it is simply mark-to-market environment, in any panic, every institution's gone.
Well, not if they're closed-end mutual funds. They're not gone. We have 25% of the financial assets in this country are held by equity finance mutual funds. By the way, I don't work for any mutual fund company, just to be clear. I'm not talking about the money market funds, which are leveraged. I'm talking about the other mutual funds. There are 10,000 mutual funds in total. About 7,500 are equity-based mutual funds. Not a single one of those financial intermediaries went out of business because of this financial crisis. So we had a financial earthquake. Certain structures collapsed, and the others, which were built out of stone, did not collapse, and we rebuilt out of straw, as far as I can tell. So I guess we're going to have to differ on this. But let me ask you a different question, which is on the money markets. Do you think they should be mark-to-market?
It seems to me
I mean, the mutual fund money market funds.
mark to market as a general rule, let's leave the money market mutual funds aside for the moment, it seems to me a very, very dangerous and an area that deserves a great deal of looking hard. But it's really odd. I'm in favor actually of looking at real numbers in real time. Yeah. But the way mark-to-market often works in terms of how it translates into the financial system, it's point-of-time mark-to-market. So the question becomes whether on December 31, when you often have financial, that mark-to-market on that day at that time is the decision which you ought to take in terms of how you measure all kinds of things within the institution. It's one of the reasons supervision, again, is so important, because regulators have the opportunity through a supervisory mechanism to look at an institution over time. And it goes to John's excellent point of who is management? What is the real quality of their book? And the problem with any of these mark-to-market disciplines, it seems to me, is there's certainly good in them. And in our country, we certainly want a more transparent, we want a transparent society. But at the same time, there's danger in it too, because you make wrong judgments based on simply that.
I agree 100%.
So money market mutual funds should be allowed to back to the buck without any change in their regulatory status? Or, I mean, how would you guys deal with that? Would you require them to pay for FDIC insurance? So we just
I think
insured them.
Gene said it up front. We weren't answering the money market question per se. I'm not particularly knowledgeable about the trade-offs in money market funds. But any mutual fund you buy into, whether it's money market or otherwise, there are risks. You may have 100% capital, no leverage, et cetera, or maybe there is leverage. But the point is, the value of that fund can go up or down.
Profoundly, and I think one of the real dangers, Larry, of assuming that any part of the financial system in and of itself is not going to be volatile in a crisis is that the system is so complex, and you don't know where people's sort of panic will roam, irrespective of how well it's run. To your excellent point, John, even if you have one-to-one, people can lose a lot of money and say, I want all my money out. If it's on a mark-to-market basis, they're going to take their money out at a big loss.
There's two things, and then we're going to go to questions right after this little short comment of mine. There's two different things. Panic's always going to happen, and stock markets are going to fluctuate like crazy. In '87, we had the stock market went down like crazy. In 2000, 2002, the stock market crashed 50%. But none of the financial institutions collapsed. So the specter of these financial intermediaries collapsing seems to scare people like crazy, and that could be averted by this alternative system. But let us ask the audience now for their questions, and please come up to the mic and give us a question or two. Nobody has any questions? Surely some. Yes, please. Just come right up to the mic. Don't need to have me be able to see your hand, which is a little bit hard to do because of.
Okay, I have a question for John Reed. The kind of size and maybe potential complexity of Citigroup was thrust into the spotlight last week when the Federal Reserve rejected their capital plan. Just kind of wondering your thoughts on the complexity of the organization, and if Citigroup is a very complex organization, is it part of the global sprawl that was part of Citicorp? Does that make it more risky to be in multiple countries, multiple businesses? Or is it more the consumer versus corporate split that you talked about? Thanks.
Size is one thing, but multiple business lines is the other. And I, of course, spoke about the culture of management that's required if you're dealing with capital markets as opposed to if you are not. Citi today is immensely large, and it's geographically dispersed, but it's been geographically dispersed since 1902. The complexity, I think, comes from the lines of business. They have major capital markets as well as very traditional banking kinds of operations, and that makes for a very difficult management structure. And if anybody here wants to really get scared, they should read a book called Command and Control, which is a story of how the United States operates its nuclear weapons. And the conclusion is that human systems are immensely difficult to manage with discipline. And banks are no different. When you end up with a couple 100,000 employees, which is the situation at not only Citi, but a number of these institutions, even if you know exactly what you want to do to make sure that it happens throughout the organization is an amazingly difficult kind of task. So I would argue that Citi's problems, as referred to in the press, I have no inside knowledge whatsoever, reflects this complexity. They seemingly, in the minds of the Fed, were unable to create whatever the Fed was looking for. And when you're talking about an institution that is large in size, diverse in activities, and has gone through a certain amount of managerial turmoil, you can well imagine that it was very difficult for them to respond to the requests that they got, just due to this scale, complexity, lines of business, and the fact that they've had 3 or 4 CEOs over the last 10 years can't have helped.
More questions? Yes.
You were described as transformational, Mr. Ludwig, when you were the controller of the currency. You had an interesting history, and I was wondering what the takeaways would be from your experiences as you basically introduced innovation through your role.
Well, there's some interesting ones for me. Thank you for the question. So one that I think is fascinating is we encouraged Community Reinvestment Act lending and lending to low and moderate income people. Interestingly enough, there have been those who have tried to claim that kind of advancement is, in fact, they go so far as to say the cause of the financial crisis. But in any case is in and of itself unsafe. Just not true. The Boston Fed and the San Francisco Fed did a long study of this, it's in a book, and found that in fact CRA lending, that is lending to low and moderate income people done properly, is not only transforming in terms of their own life experiences, but also in terms, and it's perfectly safe. Is it exactly as safe as lending to a person with great means? Maybe not, but perfectly safe if done correctly. Innovation in finance, it seems to me, is something we don't want to stop, because the wonderful thing over the last couple hundred years of the development of the banking system through the national banking system in 1863 is opportunity and economic development as well. I mean, in our era, one of the people I most respect and dote on, and that we tried to work with when I was at the OCC, is Muhammad Yunus, and the enormous contribution that microcredit lending has made to global poverty elimination. So, as I look back, I think there is a balance between innovation and safety and soundness, but I think the Comptroller's Office has actually done a good job of making that balance and allowing things to grow up and basically support a growing economy.
We have time for one more question. Let me just, if there's no other questioners, let me just raise it to you folks. Apart from the whole issue of the issues we've been discussing, the more narrow issues about the financial system, how do you see the world economy today? Are you upbeat? Do you see it's, what would you do if you were running the world economy right now?
Go ahead. Running.
Well,
Short answer.
As with a lot of finance, so much of what makes finance happen, it seems to me, is what they used to call humors. That is, individual amount of confidence or lack of confidence. And we're living in an enormously dynamic era where more discoveries are being made daily than probably were made in the period from 0 to 1700. that offers tremendous opportunities, elimination of poverty, opportunities for a better environment, but it also creates all kinds of opportunities for risk. And so I would say that in terms of the world economy these days, my own personal bottom line is keep your seatbelt fastened tight.
Yeah, I'd sign up with that. I think the opportunities are clearly there, and there's no question in the last 20 years there's been an immense change in poverty levels on a global scale, and that's all for the good. We have a very big interconnected system, and I think the biggest challenge is government. Bad government is the single biggest problem in the world, and bad government is distributed. I mean, there's really horrible, and there's a little bad, and good exists in small pockets. But, you know, the question of can we get this interconnected system to maintain some momentum? I think it's possible, but it's certainly challenging, and in the short term, I definitely have my seatbelt on.
Cool. Okay, well, thank you so much.
Yeah, John, Gene, Larry, thank you very much for your tremendous contribution.
I appreciate it.